Welcome back to The Deep Dive, the show built to distill the world's most complex research into the insights you need now. Today, we are staring down the barrel of one of finance's biggest challenges, predicting the insane volatility of the crypto market. We're talking about the wild swings in Bitcoin, Ethereum, Dogecoin, Litecoin. These assets often move on rumor and, well, sheer chaos, sometimes defying all logic. Our mission today is to break open a really remarkable piece of research. It seeks to impose some order on this chaos. Researchers proposed a new hybrid price prediction system, a kind of, next generation digital fortune teller. And it combines two absolute titans of machine learning: long short-term memory, or LSTM, and extreme gradient boosting, better known as XGBoost. Now, this isn't just some incremental improvement. This custom two-stage model consistently and significantly outperformed every traditional and standalone prediction system they threw at it.
Yeah, and that consistency is really the central finding here. What's fascinating, I think, is understanding why this complexity is even necessary. You see, cryptocurrency prices aren't just simple time series data points. They're super sensitive to market psychology, huge fluctuations in trading volume, sudden geopolitical shifts, broader macroeconomic sentiment.
Whole mess of factors.
Exactly. So a single unified model that maybe focuses on only one type of data, like pure historical sequence, for instance, is just, well, it's incapable of integrating all those disparate nonlinear forces efficiently. This hybrid architecture, it's designed specifically to conquer that integration challenge.
Okay, let's establish the terrain then. We have to start with the data itself,
Yeah.
right? Why is this market such a nightmare to predict compared to, say, the S&P 500? Our source material looked at the core characteristics of BTC, ETH, DOGE, and LTC. And the key mathematical takeaway is that they all exhibit what researchers call leptokurtic distributions with fat tails. Sounds technical. What does that actually mean?
Right. It's basically the statistical equivalent of saying the floor is lava. Essentially, in a standard market, extreme events, like a 20% swing in a day, are statistically pretty rare. Leptokurtic means those extreme price movements, those fat tails, have a far, far higher probability of occurring than in a market with a, normal bell curve distribution. It means when you think you've seen the worst crash, the odds of an even bigger, more sudden spike or drop are still statistically quite high.
So you're saying the risk profile is just permanently elevated?
Pretty much.
And the market dynamics seem to reflect this too. The data shows that trading volume doesn't just bump up slightly. It tends to spike wildly during those big price movements, especially during those manic bull markets we sometimes see.
And critically, the correlation between these different cryptocurrencies has been increasing over time. So during periods of market stress, Bitcoin and Ethereum start moving together much more closely than maybe they did before. They become less diversified, more prone to sort of synchronized crashes.
Which makes things even riskier.
Exactly. And if we connect this back to our modeling challenge, traditional time series models like the classic ARIMA, they're absolutely useless for data that behaves this way. Just can't handle it. They can't cope with the extreme nonlinearity or the high dimensional data, which is why the industry really had to pivot to deep learning, specifically things like LSTMs, which are actually built to capture these long-term nonlinear dependencies.
Okay, so if the market's too chaotic for a single tool, they built a two-stage weapon. Let's get into the mechanics of this hybrid architecture now, because this seems to be where the real genius lies. This isn't just two models running side by side, is it? It's more like a sequential pipeline.
Exactly right. The system is designed kind of like an assembly line. The first stage is focused purely on extraction and memory, you could say. And then the second stage focuses on the prediction and the refinement. So stage one is the LSTM. We can think of it as the historical signal extractor. Its core function is capturing those really complex temporal dependencies. It's not just looking at yesterday's closing price. It's remembering patterns that might have happened 2 months ago and understanding how that history relates to what's happening right now. The LSTM takes the standard multivariate time series, high, low, open, close, volume, market cap, and processes that massive sequence of data.
Right, and it uses its famous gates to decide what memory is important to keep, like a highly selective editor sorting through everything.
Precisely. It's very selective. And the output isn't the final predicted price. That comes later. The LSTM processes all that historical data and spits out something very specific: a single fixed-length latent vector. It's often called ZIO. Think of the serial dealer as the compressed critical memory signature. It's like the essence of the historical pattern distilled down into a manageable digital summary.
I see. So the first model's job is basically just to summarize all that chaotic time series data into a nice structured signal. But hang on, why not just feed all the raw historical data, including the volumes and market caps and everything, directly into the second model, the XGBoost? Why is that compressed Zella vector so necessary? Isn't stage one just adding complexity and maybe increasing computational costs for no reason?
Ah, that is the critical question, isn't it? And the answer is, well, if you feed raw, high-dimensional time series data directly into XGBoost, it really struggles. XGBoost is fundamentally a regression specialist. It is absolutely state-of-the-art for structured tabular data, think spreadsheets. It expects clean, sort of independent features. Time series data is inherently dependent, it's noisy, it's sequential.
Messy.
It's very messy. The LSTM solves this by basically acting as a sophisticated feature engineering layer. It turns that messy sequential noise into a clean, structured feature vector that perfectly summarizes the relevant history. Then comes stage two, the XGBoost. Now, the XGBoost takes that structured distilled memory vector $, and plus any auxiliary features you might want to add, maybe things like sentiment scores from news, maybe macroeconomic indicators, though they didn't fully use those in the specific test. And then it performs the final nonlinear regression to get the price prediction. Because $, has already captured the temporal dependencies, XGBoost can focus its considerable strengths on capturing the complex interactions between that historical memory and those other structured features.
Okay, so the synergy is really what makes it a breakthrough. You use the LSTM specialized talent for sequential data feature learning, and then you leverage XGBoost's robustness and efficiency in handling structured data and capturing those tricky nonlinear interactions between different variables. It's like a perfect partnership tailored for this specific erratic financial domain. All right, now that we know how it works, let's talk about the payoff, because here's where it gets really interesting, the quantitative proof. In high-stakes financial modeling, even marginal gains can be worth millions, right? So how much better, numerically, was this hybrid system?
Yeah, the results were quite compelling. They showed consistent, measurable dominance across all 4 cryptocurrencies they tested. The researchers used 2 key metrics here, mean absolute percentage error, or MAPE, which basically tells you the average size of the error relative to the actual price, and lower is better, obviously. And the other one was min-max normalized root mean square error, or min-max RMSE. We use min-max RMSE because it normalizes the error, which lets us easily compare performance across assets with vastly different price scales. You know, comparing Bitcoin's price prediction error to Dogecoin's price error fairly.
Makes sense. So what were the numbers?
The hybrid Lstm+Xgboost model really set the new benchmark. It achieved a test MAPE of just 0.0488 and a test min-max RMSE of 0.0659.
Wow, okay. That sounds extremely low, especially for assets this volatile. How did the individual models do on their own?
Well, they just couldn't keep up. The standalone LSTM, it lagged significantly with a MAPE of 1.0567. So that's already a pretty massive relative improvement the hybrid achieved right there. The standalone XGBoost was marginally better than LSTM at a MAPE of 0.0533, but still, nowhere near the hybrid's performance. And the traditional benchmark they use, ARIMA, was the weakest performer by far, with an MAPE up at 0.0671.
Okay, so the takeaway is pretty clear there.
Yeah, the hybrid model just captured that complex interplay of temporal patterns and nonlinearity that the others simply missed when they were working individually.
Well, we should probably mention the scope of the study was pretty comprehensive too, wasn't it? They didn't just test this on one asset using global average data. They evaluated it on BTC, ETH, Doge, EE, and LTC using both global data and localized exchange-specific data. That adaptability seems crucial for the decentralized world of crypto where, regional trading volume can really affect price action sometimes.
Absolutely, that's a very important point. But despite the superior accuracy, the research paper itself is quite upfront about the critical limitations. And these limitations actually point us toward the next frontier of financial forecasting, I think.
Right. Okay, let's dig into those. The first one they mentioned is overfitting. Always a risk with complex models. With data this volatile, how do we make sure the model isn't just like a perfect historian of a last crash, but actually a good predictor of the next one?
That's the core risk of complexity, isn't it? The more complex the model, generally the higher the risk that it has learned the noise and the specific quirks of the training data, rather than the true underlying signals that will generalize. For systems dealing with such erratic assets, constant validation and revaluation are absolutely required to prevent it from becoming overly specialized and losing its generalizability to new, unseen market conditions.
And then there is, the elephant in the room that seems to plague all deep learning. The limited explainability.
Yeah.
The black box problem.
Precisely. While XGBoost on its own is generally considered one of the more transparent machine learning techniques out there, when you chain it behind a deep neural network like the LSTM, the end-to-end system becomes highly opaque. Very hard to interpret. We can confirm that the prediction is good. We see the low MAPE, the low RMSE, but we don't fully understand why the model decided to, say, predict an upswing or a downswing at a specific moment. In finance, where risk management is absolutely paramount, this lack of clarity is a massive hurdle, a really big one.
Okay, let's talk about features next. The model, as tested, relies heavily on price history and technical indicators. But we all know the crypto market is hugely reactive to non-quantitative signals, right? Memes, tweets.
Yes, exactly. That's the third major limitation they identified, static feature dependency. The model is currently only seeing the sort of engine of the market, the price action, the volume, but it's largely ignoring the road conditions, if you will. Things like news sentiment, sudden regulatory changes, maybe even celebrity endorsements or FUD campaigns. If the model doesn't integrate sentiment analysis from social media trends and news headlines, it's definitely missing critical real-world drivers of that volatility.
And finally, a very practical issue, computational cost. Why does the intensity of training and inference matter so much if the prediction ends up being accurate?
Well, it matters deeply if you actually want to deploy this model for real-time trading. Training this complex hybrid system is computationally intensive. It requires significant GPU resources, time. If a hedge fund wants to use this model for, say, high-frequency trading making decisions within milliseconds, the time it takes for the model to actually compute the next prediction might just be too slow. We ultimately need faster, perhaps lighter architectures that can maintain this level of accuracy.
Okay, so if we look at those four big limitations, overfitting, explainability, features, and cost, where does the research community focus next? What are the critical paths forward?
Well, the major goal, I think, has to be integrating those crucial external features. We need robust, real-time sentiment analysis woven directly into the prediction pipeline somehow. And actually, the hybrid architecture provides the perfect slot for this. Those auxiliary features that get fed into the XGBoost in stage 2, that's where sentiment could go.
And what about the core architecture itself? Is Lstm+Xgboost the final word?
Probably not. We also need to keep pushing the fundamental architecture. Given that transformer models, the things behind ChatGPT and such, given that they've often outperformed traditional RNNs and LSTMs in capturing really long-range dependencies across many sequence tasks, exploring transformer-based encoders combined with XGBoost might be the next logical leap forward. They might capture even subtler, longer-term historical patterns that LSTMs could miss. And the final point, which is absolutely crucial for real-world viability, is shifting the goal function itself. What we're trying to optimize. We need to move beyond just optimizing for simple prediction accuracy, like minimizing MAPE, toward multi-objective optimization. A real trader doesn't just want the most accurate price point. They want to minimize risk, or maximize their Sharpe ratio, or adjust their position size based on predicted volatility. Future models really must be trained to optimize multiple trading objectives simultaneously, not just accuracy alone.
So wrapping up the core findings then. This research pretty definitively proves that the strategic combination of sequence modeling using LSTM and structured feature analysis using XGBoost, it creates a highly accurate forecasting tool that seems uniquely suited to the unpredictable, nonlinear environment of the cryptocurrency market. It really does set a powerful new standard.
That's the core conclusion, absolutely. Two specialized tools working together are, in this case, much better than one generalist tool trying to do everything.
But let's leave you, our listener, with the final, maybe provocative thought that really underlies the necessary future of this technology. The accuracy reported here is phenomenal, and MAPE under 0.05 is truly remarkable for crypto. But the critical path forward in finance, especially high-stakes finance, is trust. And trust hinges almost entirely on explainable AI, or XAI. Think about it. If we have a system that predicts the next market crash with incredible accuracy, but we can't fully open that black box to understand the reasoning, if we don't know why it decided to suddenly liquidate, say, $1 billion in assets, can we truly trust it when the stakes are that high? The next generation of these financial models won't just need to be accurate. They will absolutely need to be transparent, perfectly understandable. That's the real challenge ahead, something for you to mull over.